topic is Roth conversions. Specifically, how much tax are you going to have to pay if you do a Roth conversion? I find Roth conversions to be a very effective strategy, but when I look at Roth conversions, there are two things that stick out to me. Number one, how do you feel about tax rates going forward? In other words, do you think taxes are going to be higher in the future? Number two, and this may be a little bit more important, where am I now in terms of my income, and would it be cost prohibitive to pay the tax now? And I'm going to show you in today's video how that all works out, how income tax is calculated, and also what happens when you throw income right on top to create a Roth conversion. This is a tax rate cylinder. You may remember this from chemistry class. I think you'll know as I start to explain it. We have what's known as a progressive tax system. We pay tax at different rates depending on how much income we have. So we pay some at 10%, some income at 12%, some income at 22%, some income at 24%. The upper limit of the 24% bracket is $321,000. So most people are below that. So what happens as income comes into our picture, we pay some at 10, some at 12, some at 22, and some at 24. Now, this seems pretty straightforward. The problem becomes is when we do a Roth conversion, we're throwing more income into this picture, and thus we are rising in the cylinder. This is how we end up paying more tax. So let's look at an example. In this example, we have $100,000 of income. There's a $24,000 standard deduction, leaving us a taxable income of $75,000, $75,600 to be specific. So this is the number that all of our taxes are going to be calculated on. So how do we calculate the tax? Well, we know that the first $19,400 is going to be in this area. We're going to take 10% on that. We know the next bit is going to be in this area where we're going to pay 12%. We are not rising with taxable income above $78,950, so we know we're going to be in these brackets down in this area. So the tax burden on that is $8,867, and it's an effective tax rate of 11.4%. Okay, not too bad. So the marginal tax rate is 12%. That's the highest tax rate we're going to pay. But the blended or the effective tax rate is a little bit lower because we're blending these rates, some at 10%, some at 12%. So that's how we would calculate a normal amount of tax that's due. So let's move on now and talk about what happens if we have a Roth conversion. Let's assume for a second that we are going to convert $50,000 in this calendar year. We'll call this the conversion. We're going to convert $50,000. So what we do here now is we take the 75 we received before in income plus 50. That's $125,600. Now, this is a significantly bigger number. That's why we have to be very careful to make sure this works out economically. As you can see, we are now going to be up here in terms of our marginal tax rate. Now, that doesn't mean that we are now paying 22% on every dollar of income we have earned. It means that the highest echelon of our income is going to be in that category. The tax burden on this is about $19,300, federal tax burden, right? And that is an effective tax rate of 15.4%. So although we have now gone into the 22% tax bracket and we are paying a higher amount of tax on the conversion, we are still at an effective tax rate of 15.4%, which is not so terrible.
Darryl, do you think people like our videos? Beats me. How do we find out? We can ask them. How? Like this. If you like our videos, give us a thumbs up below. Anything else? Yes, subscribe. This way you'll see our content right away. Tell the viewers why we do this. To help them create safety, simplicity, and most of all, financial strength in the future. Got it. To subscribe, just click the button below. Now back to our regularly scheduled video.
Here's the thing as it pertains to Roth conversions. Yes, we are accelerating the tax. That's part of the equation. That's why I did this video, to show you how the taxes are calculated. A common myth in retirement is that you're going to be in a lower tax bracket. That is, you're going to stay lower because all of a sudden you're not working. What the research shows and what my personal experience shows is that people in retirement want to spend almost as much money as they spend while they're working. Plus, if they don't spend the money on cruises and what have you, they're going to spend it on medical. And we also know that the whole deduction picture changes a little bit. The securement way is operating from a position of strength, and it's looking at something like this and saying, is it possible that we can take some risk off the table and feel better in retirement because we've accelerated some of the tax? Here's what I know. Just because you have $100,000 in an IRA, it does not mean you have $100,000. You do have a future tax obligation with a partner, the government, and they're the only ones that get the vote. So, above anything else, please take action, because you know, you've heard me say it before, there are many ways to run into a secure and comfortable retirement, but doing nothing is not one of them.